Hi, good afternoon. This session will be a discussion for the remaining problems in common stock valuation, problems 5 and 6. They would involve equity valuation and firm valuation. So let us begin. Problem 5. Transworld Communications Incorporated, a large telecom company, is evaluating the possible acquisition of Georgia Cable Company, GCC, a regional cable company. Transworld Analysts projects the following post-merger data for GCC in thousands. So we have data for the next 4 years, net sales, selling and administrative expenses, interest. We also have the tax rate after merger, cost of goods sold ratio, beta after merger, risk-free rate, the market risk premium, and the continuing growth rate, which we would presume to remain constant in the long run. If the acquisition is made, it will occur on January 1, year 1. All cash flows shown in the income statements are assumed to occur at the end of the year. GCC currently has a capital structure of 40% debt, but Transworld would increase that to 50% if the acquisition were made. GCC, if independent, would pay taxes at 20%, but its income would be taxed at 35% if it were consolidated. GCC's current market-determined beta is 1.4, and its investment bankers think that this beta would rise to 150 if the debt ratio were to increase to 50%. The cost of goods sold is expected to be 65% of sales, but this could vary somewhat. Depreciation generated funds would be used to replace worn-out equipment, so they would not be available to Transworld shareholders. The risk-free rate is 8%, and the market risk premium is 4%. So the questions are as follows. Letter A, what is the appropriate discount rate for valuing the acquisition? Second, we have what is the continuing value? And third, what is the value of GCC to Transworld? So certain things to take note of. From the given, we have the free cash flows to equity. We can calculate it. And the appropriate required rate of return for equity, we would be able to calculate the equity value. The approach that we're going to use is equity valuation. As such, we have to be consistent. We're going to project free cash flows to equity and then discount it back to now, year 0, at the appropriate discount rate, which is the cost of common equity. So, because we're looking things from the point of view of Transworld Communications, we're going to assume the figures that would be appropriate post-merger, after the acquisition. So let us begin. Let us begin with the discount rate calculation, the cost of equity. From the given of the problem, we can calculate the cost of the equity using the capital asset pricing model, CAPM. Accordingly, we have R sub S, the required rate of return on equity. This is equal to R sub RF, the risk-free rate, and to be added would be the risk premium on the stock. The risk premium on the stock is the product of the market risk premium and the beta of that stock. That is RP sub M times beta of S. So we would have the following. R sub S is equal to 8%. Realistically speaking, this is too high. We're going to add the risk premium on the stock. The risk premium on the market is 4%. Multiply this by the beta of the stock, 1.5. The risk premium on the stock, on this stock, is 6%. So we would have R sub S, 8% plus 6%. The required rate of return on equity is 14% as far as Transworld is concerned. Now that we have the appropriate discount rate for this valuation, we are going to proceed to the calculation of the free cash flows to equity. We have the following in thousands of pesos for years 1 to 4. Sales revenue, we have 450, 518, 555, and 600 respectively. We are going to deduct the cost of goods sold. Cost of goods sold, accordingly, it would be 65% of sales revenue, 292.5, 336.7, 360.75, and 390 respectively. From here, we can calculate the gross profit. Deduct the second line from the first line. We would have 157.5, 181.3, 194.25, and 210 respectively for years 1 to 4. Now we are going to deduct the selling and administrative expenses. 45, 53, 60, and 68 respectively. So we have the following earnings before interest and taxes. EBIT, 112.5, 128.3, 134.25, and 142 respectively. Remember that we are looking for the free cash flows to equity. Everything that will be attributable to the equity participants, our common shareholders. Because this is what we are looking for, we have to deduct the interest expense because they would be attributable to the debt holders. So we have the following interest expense. For year 1, that's 18, year 2, 21, year 3, 24, and year 4, 27, bringing us the following earnings before taxes or net income before taxes. 94.5, 107.3, 110.25, and 115 for the next 4 years respectively. This would be the starting point of our free cash flow to equity calculation. Now, the first step that we're going to do after this would be to calculate the after-tax earnings, the net income after tax. EBT times 1 minus T, the tax rate is 35%. What we are going to do is to tax the earnings before taxes that we have calculated. They would be 94.5 times 1 minus 35%, 107.3 times 1 minus 35%, 110.25 times 1 minus 35%, and 115 times 1 minus 35%. The next thing would be to add back the depreciation. But for this problem, we are going to presume that the depreciation, which is supposed to be added back because these expenses which were deducted in arriving at income, they do not involve cash outflow. So we have to add them back. We call this depreciation generated funds. The problem presumes that whatever depreciation expense that will be incurred for the period, it would be equivalent to the replacement of the worn out equipment. So as equipment is wearing out, we are going to assume that whatever depreciation expenses that we have incurred for that period would be used to replace the wearing out of that equipment. As a result, whatever depreciation expense we are to recognize, we are going to recognize an equivalent capital expenditure. Remember that capital expenditure will be used to replace the worn out equipment. So there's no more point of assuming any figures. Whatever will be added back as depreciation and amortization expense, that would be equivalent to the capital expenditures that will be presumed to be expended. Okay, so that would be 0 plus 0 minus 0 for all of the years. We are not going to assume any increases in net working capital as well. No new debt issuances and no debt repayments. Nothing to be presumed. We would have the following free cash flows to equity. So basically, only the taxes would have an effect on the calculation for this problem. 61.425 for year 1, 69.745 year 2, 71.663 for year 3, and 74.75 for year 4. So, equity value calculation. We now move to the equity value calculation. We have a timeline and project the following cash flows. Again, year 1, year 2, year 3, year 4, up to forever. So the next requirement will be to calculate the continuing or horizon value. We also know this as the terminal value. The terminal value basically represents the cash flows of the constant growth phase. That would be from the terminal date until forever. We are going to assume the terminal value as of year 4. We call this the equity value as of the end of year 4. We need the free cash flows to equity as of year 5. What we can do is to grow the year 4 cash flow by 1 plus the constant growth rate. 74.75. Multiply this by 1 plus 7% and divide this by the cost of equity of 14% less the growth rate. Again, let me reiterate this. We are using the free cash flows to equity. We are going to discount them back to whatever date using the appropriate discount rate for that cash flow. What's the appropriate discount rate? Because this is free cash flow to equity, it would be cost of common equity. So we would have 14% less 7% as our denominator. That would give us the equity value as of year 4, 1,142,600. This is the approximate equity value as of year 4. Again, the terminal value, the value as of year 4, the horizon or continuing value, 1,142,600. Now, for our final requirement, we have to look for the value of the equity as of year 0. That's now. What we need to do is to bring back all of these cash flows to year 0. Now, for the year 1 cash flow, let's do it one by one. 61.425. We multiply it by 0.87719. Year 2 cash flow, 69.745. Multiply it by 0.76947. Year 3 cash flow, 71.663 times 0.67497. Year 4 cash flows, 74.75. We multiply this by 0.59208. Again, these cash flows were multiplied by their respective PV factors. For each year, under a discount, assuming a discount rate of 14%. Finally, the terminal value we have at year 4, this is 1,142,600. We multiply this by 0.59208. The PV factor as of year 4. Adding these things up, we would have the following equity value now: 876,700, approximately that amount. Again, the equity value now is approximately 876,700. This is what we call the equity value. If we want to arrive at the presumed stock value, the presumed intrinsic value of one share of common stock, all we have to do is to divide this equity value by the number of common shares outstanding. So let us now proceed to firm valuation. For firm valuation, we have the following in problem 6. Dozier Corporation is a fast-growing supplier of office products. Analysts project the following free cash flows, FCFs, to the firm during the next 3 years, after which the free cash flows is expected to grow at a constant rate of 7%. Dozier's weighted average cost of capital is 13%. So we have the free cash flows in millions for years 1, 2, and 3. Again, these are in millions of pesos. Take note that the year 1 cash flow is a negative, meaning it is an outflow. So the requirements are, letter A, what is Dozier's horizon or terminal value? Then B, what is the firm's value today? And C, suppose Dozier has 100 million pesos of debt and 10 million shares of common stock outstanding. What is your estimate of the current price of the share? In other words, what is your presumed intrinsic value for each share of stock? The free cash flows to the firm are already given. We may proceed directly to the firm value calculation. So the firm value, we will need the free cash flows to the firm. Again, they are year 1, negative 20 million pesos. Year 2, 30 million pesos. And year 3, 40 million pesos. If we are going to arrive at the terminal or horizon value, we would need the free cash flows to the firm as of year 4. So to arrive at the horizon or terminal value, this is as of year 3, we would need to multiply the free cash flows of the firm for year 3, 40 million pesos, by 1 plus the growth rate of 7%. This is for us to arrive at the free cash flows to the firm as of year 4. Again, the cash flows here are to the firm. If we are to divide this, we would need the denominator equivalent to the required rate of return for all financiers of the firm. Unlike in the previous problem where we were using the free cash flows to equity, here we're using the free cash flows to firm. Apples to apples, let us be consistent. Because we are using the free cash flows to the firm, we're going to ask this question: who finances the firm? Where does the firm get its funds? Okay, the firm is funded by both the debt holders and the equity holders, not the equity holders alone. Both debt and equity holders. So instead of using only the cost of common equity, we need to incorporate the cost of debt as well. Because again, free cash flows to the firm would pertain to both equity and debt holders. Share in the free cash flow. So instead of using the cost of equity, we have to use the WACC, the weighted average cost of capital. So we are to divide the cash flow by 13% less the growth rate of 7%. The firm value as of year 3 would be 713.33 million pesos. Again, the horizon or terminal value or continuing value is 713.33 million pesos for the firm. Finally, we are going to arrive at the firm value today or now, that is year 0, by discounting all of the cash flows, including the terminal value, back to year 0. So we would have the following. We are going to use the PV factor for 13%, 1 year from now, 2 years from now, and 3 years from now. They are 0.88496, 0.78315, 0.69305, respectively. We will have the following discounted cash flows. For year 1, that's negative 17.70 million. Year 2, 23.49 million. Year 3, 27.72 million. As for the firm value, we are also going to discount it from 3 years from now. That will give us 494.38 million after multiplying the terminal value by the PV factor of 0.69305. Add all of this up, we would have the firm value now. That would be 527.9 million pesos. Again, 527.9 million pesos. Now that we have the firm value today, in order to arrive at the stock price, the presumed stock price, or the intrinsic value of the stock, we are going to deduct from the firm value of 527.9 million the debt or the preferred share value of 100 million. The debt or the preferred share value of 100 million. In this problem, by the way, there are no preferred shares. There's only debt. That's 100 million pesos. This will lead us to the equity value of 427.9 million. Again, to be contrasted with in the previous problem. In the previous problem, whatever we arrive at, it is already the equity value. Upon discounting the cash flows, it is already the equity value. But in this case, we are using the firm value. We have used the free cash flows to the firm. We have used the weighted average cost of capital. Whatever we arrive at as of year 0, it is the value of the entire firm. So we have to remove the portion that pertains to our debt. In this case, the market value is 100 million. Deduct 100 million from the firm value of 527.9 million. Again, that's 427.9 million. Divide this by the number of shares outstanding, 10 million pesos. We have the presumed stock's value, the intrinsic value, or in equilibrium, this is the stock price, 42.79 pesos. Again, the stock value is presumed to be 42.79 pesos per share. So those are the approaches to valuation that were discussed. Those are the approaches to valuation relevant to the last two problems that we had. So this is basically it. So I would appreciate it if you like this video, share it with your batchmates or classmates, and subscribe to my channel. Like, share, and subscribe.